Hello, everyone. We will get a minute to let some stragglers log in, so hang tight. Thanks for joining today's Tech M&A Outlook 2018 Mid-Year Update. My name is Kathy Rowe, Content Marketing Specialist here at 451 Research. Before we dive into the content, I just want to give a brief introduction to 451 Research for those of you who aren't familiar with us. Research is a top-tier research and advisory firm headquartered in New York City. Our team of more than 100 analysts cover more than 2,000 technology vendors and service providers every year. 451 Research provides unique insight into emerging disruptive technologies and the companies that are taking them to market, and deliver that insight via syndicated research, advisory services, live events around the world. Before I turn it over to today's presenters, a few housekeeping items. First of all, as for participating in this webinar, you have an opportunity to receive a $200 discount off of a registration fee for our Hosting and Cloud Transformation Summit, also known as HCTS. This event is held in September. It's our arguably largest event of the year, and we will be covering an extensive amount of tech M&A data from analysts and our presenters today. So keep in mind to save that code and get your discount. Other housekeeping items include webinar slides can be downloaded in the attachments and links section of the BrightTalk platform. You can submit questions to the presenters in the same platform for the Q&A at the end of this webinar, and the webinar will be available immediately after today's session, the recording of the webinar, excuse me. Without further ado, I will turn it over to Brenon, who will be our first speaker today.
All right, well, thank you, Cassie, and thanks to all of you for joining us on a special edition of our Tech M&A Outlook webinar. You're going to see we've already seen a number of dramatic changes in this multi-billion-dollar tech M&A market. During the webinar, we're going to highlight and offer some thoughts on what's happened so far, but also maybe more importantly, take a look ahead and see how some of those new trends will play out in the second half of the market. And just to quickly introduce myself, since I'll be your host this morning, my name is Brenon Daly, and for the past dozen years now, I've headed up the M&A practice here at 451 Research. Now, certainly, as I mentioned, a lot of material to cover today. Some of the key areas that we'll be focusing on today include the key buyers coming back into the market, right? These are the tech bellwethers, the companies that we look forward to and look to set the tone in the overall market. They sat out much of 2017, but they've come roaring back into here in 2018. We'll look at some of their deals in detail, what drove them, and maybe more importantly, what's changed from 2017 here to 2018. We'll also spend some time looking at the rivals to these corporate acquirers when it comes to M&A, and that's private equity. Far from backing down to these strategics, they're actually on pace for record numbers of transactions, both in terms of volume and the spending for those. And if you thought things were busy in the tech M&A market, well, the tech IPO market is just as busy. We've already seen as many IPOs here in the first half of the year as we typically see in a full year. And then finally, even those startups that aren't going public are finding fairly rewarding exits themselves. My colleague Scott Denne will take a look at the record-setting market for VC-backed companies there in his section. So obviously a lot to cover. You can notice too, we do have time set aside for your comments and questions, or even if you want to throw in a World Cup prediction, we'll take that too. But we do have time set aside at the end. The easiest way to do that, as Cassie mentioned, is just to use the Bright Talk screen itself. We'll get to as many questions as we have time for. But just to start, let's open with the big picture. And I should know this quick advertisement for our 451 Research M&A knowledge base. This is the industry's only tech-specific M&A database. It's the source for much of the information that we're going to be covering today. You're going to see it in action throughout all of today's webinar. And in fact, at the end of today's webinar, we actually have a little time set aside for a bit more on the product. So if we just look at the big picture, and what I've done here is gone back a dozen or so years and run a cut of activity, both the spending, which is represented by those blue bars coming up off the bottom, and then the number of transactions each of those years represented by that brown line across the top. And I think what I'd highlight is the most recent activity. If you look at the far right-hand side of the slide, $260 billion of consideration passed from buyer to seller already here in 2018. Right? If you compare, just to put that number into perspective, right, a very strong start, already here in the first 2 quarters of the year, we actually exceed the full year totals for 2008 through 2013 if you look at the middle of the slide. So again, a very strong start, half year totals topping full year totals. It's also a pretty significant acceleration. If you think about 2017 into 2018, here we're on track, right? If we annualize the mid-year totals, which admittedly is not an exact science, but certainly as a directional indicator, it's useful. If we annualize the totals, I mean, we're talking about $520 billion of spending this year, which would be, as you can see, the second highest overall spend. But I think the point I would make as you look at the totals here, and again, this is tech and telco on a global basis, so a very comprehensive measure of activity. Regardless of where the final dollar figure for this year settles out, it's very clear if you compare last year to this year that it's a very different climate for M&A right now. And again, I think that shows up most prominently if you look at the activity of the big cap tech names. Think about companies like Microsoft, Salesforce, SAP, PayPal, Adobe, right? All of those companies, all 5 of them, have announced billion-dollar-plus transactions so far here in 2018. Last year, not a single one of them put up a billion-dollar print. So in 2017, they were 0 for 5. This year, they're 5 for 5. So a very different climate. That strength, that change, also comes through when you look at activity on a more granular basis. This I've gone back to, again, our M&A knowledge base, and just run a cut for rolling quarterly total over the past half decade or so. And again, if you look at the far right-hand side of the slide, you see a very strong open here in 2018. First quarter, about $115 billion of spend. Again, this is global tech and telco. So $115 billion, about 20% higher here in Q2, to the point where, as you can see, Q2 was actually the highest spend, again, represented by those blue bars, highest spend in a year and a half. Maybe even more importantly is if you shift and look at the brown line. That's, again, deal volume, right? Almost uninterrupted slide from sort of mid-2015 through the close of last year. But notice what's happened here so far in 2018, right? We've had consecutive increases in the number of tech transactions, right? So this is more participants coming into the market, announcing more transactions with more dollars attached to them. So with this acceleration that you see, again, coming from the data from our M&A knowledge base, when you see this acceleration, it prompts the question of, well, what's changed here in calendar 2018 versus 2017? And I think, certainly you can make some case that as the new tax changes have come through, right, because they were enacted early part of this year, as those have taken shape, certainly more cash has returned to a lot of tech companies or companies overall, right, whether it's repatriated capital that had been, or repatriated profits that have been offshore. They were able to bring those back without the tax penalties. Also, the overall lower corporate tax rates, right? So the treasuries are a lot fuller. Now, I would qualify that a little bit in that tech, at least in the tech industry, right, cash has never been really the limiting factor in terms of M&A, right? It wasn't that companies didn't have money to spend. So what I think has changed here in 2018 is that confidence has returned, right? Cash and confidence equals acquisition, right? And you think about the CEOs and boards, right, who make the decisions around M&A, and they're seeing overall, healthy earnings growth, right? You're seeing 10, 15% earnings growth. Now we'll have a Q2 report card, which will start sort of next week and into that, so we'll get a better idea or more up-to-date idea of how, the performance from April through June. But overall, it's a very healthy time for earnings as well as revenue growth. And certainly, if you look at record equity prices, right, all of that put together instills a fair amount of confidence. And so I think that confidence, then you can step from that and get adventurous in some of the M&A. And just one quick example of that, think about last month and Microsoft paying $7.5 billion for GitHub, right? Now this is Microsoft is a proprietary software company, right? They sell $100 billion worth of software and services every year. Proprietary software company buying an open source company, right? 5 years ago, that would have been a non-starter in Redmond. It would have never happened, I would argue. That deal would never have found the light. But here, they're able to put that deal together, participate obviously in the DevOps movement, right? A very risky bet though. So you think, well, what's changed from 5 years besides obviously the CEO change? But 5 years ago, Microsoft's market cap was about $250 billion. Today, it's $750 billion. So if you think about a value of your company tripling in a half a decade, right, it tends to instill a fair amount of confidence and enables you then to make those risky bets if you wish, and you have the cash to do so. The other point of why now, right, what's changed now, is a little bit that there's a bit of fear coming to creep into some of the providers, right? The companies that are looking to make big bets are realizing they need to make big bets or risk being disrupted. That comes through on this slide when you look at it. Now let me explain a little bit about this slide. Each year, 451 Research, we survey tens of thousands of IT buyers, right? People who write checks for many of the products that you all sell. And what we're looking at on this particular slide is a direct question of who is the most important vendor to you today. And that's represented by those blue bars for each of those names. And the names are the names that you would expect here in the tech industry, whether it's HP, Cisco, Microsoft, Dell, Oracle. So state of play today is represented by those blue bars. But look at those orange bars by each of the names. That's the forecast for 2 years out of which vendor is going to be the most significant supplier. And with the exception of two companies, AWS and Microsoft, every other company is seeing its influence wane. So this should be a scary slide for any large cap incumbent tech vendor, right? Because the prevailing sentiment from customers that we talk to is that they are looking elsewhere. It's kind of like when you break up with somebody and they say, it's not you, it's me, but it's actually you. That's what customers are saying in this slide, right? And this is really significant because this is hundreds of buyers representing billions of dollars of IT spending. And the prevailing view, except in the case of two vendors, is that in 2 years, all companies are going to be less relevant, right? So you think about, well, how can an established company become more relevant to its customers? Well, they can expand their portfolio, right? They can offer more products. How can they offer more products? Well, they can do it organically or inorganically, right? You can go out and buy, or you can build. And if you have a heap ton of cash like you do today, the default is going to be to go out and buy. So I think, this sort of fear-based reaction, right, or this dawning awareness that, hey, customers are looking elsewhere, is prompting a lot of these moves. It's helping to catalyze a lot of the big deals that we're seeing. And we are seeing a ton of big deals. On this slide, what I've done is gone back to our 451 Research M&A knowledge base, and I've just run a cut over the past 15 or so years, right, decade and a half, of the number of billion-dollar transactions. And I've split it by front half and back half of each of those years. And you can see, as you look at it here in 2018, far right-hand side of the slide, right, record number of prints so far this year, right, 52 transactions valued, there's an equity value of more than $1 billion. Within that total, I would note also, there's 4 transactions valued at more than $10 billion. So these are big buyers writing big checks. But if you think about, right, just the pace here year to date, it's fairly astounding. We're talking about $2 billion plus transactions announced every week in and week out, from January to June, right? The other point that I'd make on this is if you look within the first half of the year, again, those are front half of the year are the blue segments, and you can see record number as you look at 2018. The orange segment there is the second half of those years. But so record number there for the front half. If you look within that and break it down quarter by quarter, we actually saw a fairly significant acceleration in Q1 into Q2, right? Q1, $22 billion plus transactions. Q3, 30. 30 is the second highest ever, right? So you think about some of these, you look at the deal flow, you think about some of these deals. I mean, these are large, significant transactions. Walmart spending $16 billion for Flipkart, or majority stake of Flipkart, right? PayPal paying $2 billion plus for iZettle. This is, you know, a company that was doing $200 million of revenue and gets a $2.2 billion exit, right? These are big deals. Obviously, T-Mobile finally got together with Sprint, right? $27 billion. I mean, these are large transactions, and that's just on the strategic side. If we think about the financials, right? Similarly, big checks being written. Largest software deal ever for private equity. That was KKR in a secondary, cleaning out basically the syndicate that took BMC private a few years ago. You remember that? They paid $8 billion plus for BMC, right? So again, largest software transaction for private equity in history. Francisco took Verifone private, $3+ billion. And if you think back to January, right, Blackstone carved out the financial markets business from Thomson Reuters, right? $17 billion.
Hi, everyone. Just cut out. We are aware. Brenon will be dialing back in a second. So please just hang tight. We will resume momentarily. Thank you.
All right. Sorry about that. We had a little fallout here. I'm in San Francisco. You'd think being in Silicon Valley, we'd have all of our IT problems worked out. We don't, apparently, but back into action. We'll pick it up again. The slide here representing billion-dollar plus transactions by buyer type. And again, I think what I'd highlight here, as we split the activity between financials and strategics, look at the growing importance that private equity is playing, right? That's, again, the orange segment for each of those years. If you look back sort of a decade ago, they were, you know, anywhere from 10 to maybe 15, maybe 20% in a particularly busy year. Right now, as you look back over the 2016, 2017, and here into 2018, they're fully 1/3 of the billion-dollar plus transactions. So, they've doubled effectively their market share at the top end of the market. And what I'd suggest, as sort of a takeaway for all of this, is that both buying groups, right, as you look at it, both buying groups so far in 2018 here on record pace, both strategics and financials on record pace for billion-dollar plus transactions. Again, combining that's how you get to 2 billion-dollar plus transactions announced each week so far here in 2018. And the reason why both of these buying groups have been able to do so many big deals is that they're willing to pay up. And what you see on the slide here is I've gone back and just looking at the top end of the market, the 50 largest transactions by corporate acquirers, right, the strategics, which are represented by that blue bar, and then the average price to sales ratio for financial acquirers, which is represented by that orange bar. And so as you can see, as the slide loads there, is that corporates, right, these are across the board, both buying groups, handing out record valuations. To be clear, this is price to trailing sales, right? But think about corporates paying 7x, 7 times trailing sales. That's 2 full turns higher than any valuation they've ever paid in past years, right? So record valuations. And you look down some of the deals, right? I mentioned iZettle earlier, getting almost 20 times trailing sales. Think about Salesforce buying MuleSoft, for 20 times sales, right? Adaptive Insights was on track for an IPO. Workday took them out at about 14, 15 times trailing sales. So these are big valuations that corporates are paying. Again, cash-heavy corporates, right? But if you think about, I think maybe more important is the uptick in private equity valuations. This is a group that historically has looked for discounts, right? They've almost invariably, with one exception there you can see, been lower bidders than corporate acquirers. But now here they are at least paying record valuations, pretty much the multiple matching what strategics have paid in years past. And I think that's an important development to highlight because in many ways, right, financial acquirers have become a lot like strategic acquirers in the tech industry. And what I mean by that is historically corporates had advantage in terms of bidding because they had cost synergies, right? They could take out those duplicate corporate expenses. So they might be able to afford to pay more upfront, realize more gains, and so ultimately, increase their return by cutting some of those, those cost synergies, basically. But now what you're seeing with private equity being so large and their portfolio so massive is that they're basically operating and acquiring a lot like the strategic vendors. So that's allowed them to sort of pay higher multiples. And you can see, they've ticked higher here, again, to the point where they're basically matching what strategics have paid over the past 3 or 4 years. The other point I'd make for both buying groups is something I mentioned earlier, right? It's a much more competitive market. If you talk to investment bankers or corporate development executives or, investors, managing directors at private equity firms, it's a much more competitive market out there, right? There's more parties at the table. And that can be true whether it's an IPO candidate like Adaptive Insights or iZettle, but also think about like Walmart and Amazon duking it out over billion-dollar plus transactions recently, right? They've around Flipkart and PillPack. So again, a lot of cash available is bringing people back into the market, which is helping to drive those valuations higher. So thus far, we focused primarily on strategic acquirers. I've mentioned private equity a little bit, but I want to spend a little bit more time here, next 3 or 4 slides, just on private equity, because I don't think certainly here in Silicon Valley, that most of the tech industry does not appreciate how dramatically private equity is reshaping the tech M&A market. And let's start, just to put a couple points on that, let's start with this. This is their activity in the front half of each of the years since the beginning of the decade. And first start with the deal volume. Notice that brown line. Every year pretty much ticking higher to the point where we had more than 500 transactions announced in just the past 6 months. right? So this is a record pace that private equity is on, triple the number in the front half of 2010. So again, this is a staggering increase by a buying group that is largely underappreciated. Also, if you think about, right, think about the firms themselves, right? These are deal machines. Private equity firms are built to transact. If we look back over the recent activity levels, right, Vista Equity averaged 3 deals every month last quarter, 3 deals a month, right? Thoma Bravo and Marlin both averaged 2 deals every month in Q2, right? And you match that pace against any strategic. At their busiest, strategics might average 1 every month, but that's probably not a sustainable pace. And yet here, 2 and 3 deals every month, month in and month out, and that's how you get to 500 plus transactions in the first half of this year. Also, if you shift to the blue lines, which again is spending, right? $75 billion worth of spend already here in 2018. Now to put that into perspective, the first half, that $75 billion, eclipses the full year totals for every year through 2014. Right? So not only more deals, but more dollars are flowing. So again, if you annualize, which admittedly not exact science, but certainly one indicator, if you average or you annualize the first half here, I mean, we're looking at $150 billion of private equity spend, which again, obviously would be a record. I think also it's important to look not only at the absolute activity, right, the absolute number of transactions, but also look at private equity on a relative basis. And that's what we've done here on this slide, is we've gone back and looked at private equity as a percent of overall tech M&A. And I think what you'll see is now, I would suggest, as you look at the far right-hand side of the slide, fully 1 out of 3 transactions, 1 out of 3 tech transactions is now sponsor-driven. Right? Even 3 years ago, it was half that level. Right? So how do you double your effective market share in just 2 or 3 years? You get very expansive, right? And we're seeing that come through in some of the strategies. At the early days, when private equity first invested in tech, they basically took the playbook that they've used in other industries and slapped it into tech. So you saw a lot of like LBOs, and you saw a lot of carve-outs, slow growth, consolidation, those sort of strategies that they've used in manufacturing and industrials and retail to some degree. Right, but what I'd suggest has changed recently here is that they've expanded that playbook. They've added in, for example, acquiring venture-backed companies, right? Unprecedented number of sort of recaps, right? So they're acquiring $50 and $60 million revenue companies that are burning cash, right? That's a profile that they never would have touched 2 and 3 years ago. And the reason why they're expanding, right, their addressable market is because they've got so much money to put to work. We're talking about hundreds of billions of dollars in equity, and you probably double that, right? The actual purchasing power is probably twice that when you figure in leverage, right? So Silver Lake right now, today, is investing out of a $15 billion fund, right? Vista and Thoma both have $10 and $12 billion funds right now. So you have to spend that money, and so you get creative and you get expansive, and that's how you get to 1 out of every 3 tech transactions being private equity backed. And that's coming through in a very important development. I mentioned earlier that for the most part, private equity's role here in Silicon Valley is underappreciated, right? Certainly in the Valley, the mindset is still, exits go to corporate acquirers, but that's not the case when you look at this slide. There has been a disruption in the tech M&A market. Just to help explain this slide as you look at it, that orange line across the top is the number of tech acquisitions by companies trading on the NYSE and NASDAQ, right? So this is US listed companies doing tech acquisitions. The blue line, that blue line coming up off the bottom, relentlessly coming up off the bottom, is the number of tech acquisitions done by private equity, right? And to be clear, that's both platform investments, so directly by the fund, as well as their portfolio companies, so bolt-on acquisitions. So it's a comprehensive measure of private equity. But look at the stunning turnaround, right? Look at the reversal, right? Private equity has emerged as the market leader, right? We're talking about 5 years ago, U.S. listed companies were doing twice as many acquisitions as private equity. And here, starting from last year, we've got more private equity deals than, public company acquisitions, right? To the point where if we, again, as we project out for the full year total, we're talking about more than 1,000 deals by private equity, which would match, as you can see, the heights of transaction deal flow for publicly traded companies. So there's been a direct reversal. Meanwhile, the U.S. listed acquirers there, as you can see that orange line sort of tailing off, right? They're on pace now for the third consecutive decline in terms of the number of tech transactions. So this is an important moment. This is a watershed moment in the tech M&A market. Now, for my final trend, and it's one, we've hit on a couple of them. Think about, the resurgence of strategic acquirers, right? All of those names, those bellwethers, companies stepping back into the market. So that's been one trend. We've talked about the relentless rise of private equity, right? The expansive playbook that they're investing out of, and the fact that in some ways they've displaced the corporate acquirers that we look to sort of lead the market. For my third sort of market trend that I want to highlight, it's one that honestly I did not expect to be talking about this year, and that's the return of the tech IPO market, right? And then just to be clear and to help qualify this, when we talk about the tech IPO market, we talk about the enterprise tech IPO market. We don't look at consumer IPOs, right? Because we are, as you all know, we are an enterprise IT research firm. So that's what we focus on. So think about B2B rather than B2C. So for example, Sonos, which just revealed its paperwork Friday, would not be included in the tally for the second half of the year. Same with last year's offerings from Snap or Blue Apron or anything like that. Again, enterprise focus. With that, and again, these are only NYSE and NASDAQ. So for example, none of the LSE listed companies like Sophos or Avast or anything like that. But these are just domestically here, the big listings. And you can see, right, already in the first half of this year, right, we basically packed a full year's worth of offerings into just the first 6 months here in 2018, right? Twice as many IPOs here in Q1 and Q2 versus any other year since the end of the recession, right? By our count, as you can see, 10 IPOs, 10 enterprise-focused startups coming public on the major U.S. exchanges. And I think it's probably more important than the total is look at the trend line. If you were to split out that first half activity, you'd notice that there was a fairly dramatic acceleration from Q1 to Q2, right? And again, that's a theme, right? We saw an acceleration in overall spending. We saw an acceleration in the number of big billion-dollar-plus transactions. And we also saw a dramatic acceleration in the number of IPOs from Q1 to Q2, almost double, right, the number of IPOs in Q2. Now, of course, some of that you would expect, right, because you expect a certain amount of seasonality with the offerings, right? Companies like to come public with full year financials behind them and then market off of forward full year totals. So, just by the calendar, you would expect to see more offerings come out in the second quarter as, the books sort of get in order. But nonetheless, it's still an important indicator that right now in the tech IPO market, there is a tremendous amount of momentum, right? And there's some acceleration to the point where even, right, in this sort of summer slowdown, right, historically not a lot of companies come public in summer months, right? They tend to take that off and then come back after Labor Day, and yet we've got Tenable on file, right? And that will be a
We've lost Brenon again. We're definitely having some issues from them over on the West Coast for this webinar, but we should have them back very shortly. Please hang tight, and we'll get this resolved as quickly as possible. I apologize for the inconvenience.
Sorry about that. We apparently dropped again. Apologize for that. Picking it back up there, I was mentioning rather than just the sheer raw number of offerings, right? It's the fact that all of them are making money, right? Think about this. All of those companies listed there, and again, this is our assessment of the first half activity, right? Every one of those companies that has come public so far this year has priced either in range or above, and then traded higher in the aftermarket. So everything is above water, right? And as you can see, when you think about the trading higher, look at the far right-hand side of the slide. That's led to some pretty rich valuations. 8 of those 10 companies trading at double digits, right? Obviously led by Zscaler and Smartsheets, trading at 20x trailing sales, right? Just to put that into perspective, that's sort of 2, 3, maybe even in some cases 4 times the prevailing tech multiples. So these are very rich valuations, and I would suggest as we look ahead to the second half of this year, right, with Tenable coming along, this is a $200 million revenue company that's growing at about 50% a year, right, in a very hot InfoSec market, and that's the kind of profile that Wall Street is going to buy all day long. So, certainly when they come out, I would imagine them being at the upper end of that range for, again, valuation. So again, strong, robust IPO market. Final point I'd make on that is you think about, again, tech offerings here in the first half of the year. If you tally up that collective market cap, you're looking at about $45 billion worth of market value creation. So it's a very strong market. And it's a very strong market despite, right, you were looking at a very strong market with rich valuations, as we saw, record pace of offerings, and yet the overall equity market is a little bit shaky right now. Think about the Dow being basically flat for the year. It's been in the red for most of 2018 on the calendar basis, right? Now, obviously, the NASDAQ is ticking higher. It's up about 12% year to date. But there's been a pretty big split between technology and virtually every other area of the market, right? You think about whether it's financials, industrial, CPG, manufacturing, all of those indexes are flat to down versus tech, again, being healthy double-digit increases. There's also concern that's showing up in the broader equity market, and this is from survey work that we do with investors, right? And each month we ask them, how concerned are you about Wall Street? And you can see this is thousands of investors saying that for the most part here in 2018, Wall Street's been a little bit shaky, right? Look back to the April sentiment, that orange line peaking at more than half of the respondents saying they are less confident about the direction of Wall Street, right, versus only 1 out of 10 back in April that was feeling confident or bullish about the direction of Wall Street. So, clearly as we look more recently, we've had a little rebound in sentiment, but I would suggest that that's basically just a bump off the bottom, right? And this is important for the IPO market because if you think about it, right, with investors saying that they're uncertain, that uncertainty should weigh disproportionately heavy on IPOs, right? At least textbook economics would suggest that when these companies come public without any track record with investors, right, they're largely unknown, unproven names, right, they should be discounted accordingly. But as you saw on the previous slide, certainly that's not the case, right? They're enjoying record valuations. So, Wall Street's clearly demonstrated that they're in the market for new tech names, right? So the IPO parade is probably going to keep rolling here, certainly for the second half. So if that's the case, if the demand is there, what about the supply, right? Where are these new offerings going to come from? And This is actually a special feature on our 451 Research M&A Knowledge Base. It's the premium edition, and we actually have formed a sort of shadow pipeline. We keep track of almost 50 companies that these are companies that we cover, right? In most cases have covered for 5 or even 10 years. But these are companies that we think are sort of a size and of a mind to go public at some point, right? So again, this is part of the premium edition of our M&A knowledge base. And what I've done is just sorted them by sector. And so when you, broadly speaking, when you look at the breakdown for some of these companies, right, you can see that the same names that we identify in the pipeline, the same markets, the same sectors that we see heavy activity forecasted are the same sectors that have actually been leading the tech IPO market, right? About 2/3 of the companies in our little shadow pipeline, and again, this is just an indicator, right? At some point, companies coming public, but about 2/3 of them that we identified are in the software and information security market, right? And those are exactly the two markets that have indeed led this record pace so far here in 2018. Now, from that breakdown, I've basically listed just a couple of quick names here, and you can see them on the slide there. These are specific companies that certainly we could imagine listing at some point, either later this year and perhaps into 2019. But I should note, I had to update this slide because I gave a similar presentation earlier this year, without the audio drops, by the way. But I gave a similar webinar earlier this year, and 3 of the 5 companies that we had on this IPO shadow pipeline actually graduated up to Wall Street. So that was Dropbox, Domo, and Zuora, all front half listings. So on this slide, 5 entirely new names, and again, this is a short list of companies that certainly have that profile to be in an IPO pipeline, and obviously excludes companies that have already indicated they're going public, whether it's SolarWinds or SurveyMonkey, and we mentioned earlier Tenable, obviously on file and will become public in 3 or 4 weeks, and again, a very strong offering from Tenable. I think you'll want to watch out for that one. It'll be $4 billion plus market cap. But I think overall, the clear takeaway about the IPO market is very receptive right now. It's a welcoming IPO market in a way that it hasn't been since the recession, right? And so I think that sentiment is going to help draw out at least as many tech startups in the second half of 2018 as we saw in the front half of 2018. So that's my forecast, and with that, I'll wrap up my presentation and hand off to my colleague Scott Denne for a more detailed look at the startups that don't necessarily come public but do opt for the other exit through M&A. So Scott?
Thank you, Brenon. So while the broader tech M&A market is approaching new highs, the trend is even more pronounced among venture capital exits. As you can see here at the halfway point of the year, venture-backed technology startups have been sold to the tune of $46 billion, well on their way to an annual record, as all the major sources of venture capital firms are operating at full capacity. What we're looking at here is a cut from 451 Research's M&A knowledge base. This includes all privately held venture-backed startups. What we don't have here is exited via IPO or venture-backed companies that have listed and then sold. This is just privately held companies. And as we dig into the VC exit market, it's important to note that since this market is very concentrated with high growth companies, emerging technologies, disruptive business models, 1 or 2 deals can really skew the totals. When you have a few outliers, it really drives that number up. That was the case in 2014, which was the previous, or the current rather, high watermark for VC exits through M&A. That was the year Facebook bought WhatsApp, the $19 billion deal that currently stands as the largest sale of a venture-backed tech company. Today, this year, we already have pretty close to that. The second largest, Walmart's Flipkart acquisition at $16 billion that Brenon talked about earlier. Right in the same neighborhood is Microsoft's $7.5 billion acquisition of GitHub. So a lot of activity on the top end of the market. But even if you set that aside, there's still a lot of activity happening lower down the market, and usually high level of activity. So setting aside those two largest deals, we're still looking at $23 billion worth of VC exits through the first half of the year, setting us up for an abnormally high year by any measure. So sticking with the top part of the market, here we have, we can see on this slide, we've got exits of $1 billion or more in the orange, the lower end of the high end of the market, so to speak, in blue. Those are the number of VC exits valued between $500 million and $1 billion. And again, like the broader M&A market, a record number of large deals. So far this year, we're looking at $7 billion sales of venture-backed companies, more than in any full year before. It's 6, the previous total. And even at the highest end of the market, we talked about the outliers, Flipkart, WhatsApp, that can drive up the market. There's several of those this year. Since the dot-com crash, we've only counted 4 venture-backed companies, venture-backed tech companies that have sold for $5 billion or more. 3 of them have come in the first half of this year. And where are the exits coming from? It's coming from those same places that Brenon discussed. Private equity is playing a continuing role, a growing role in delivering exits. Private equity firms bought 60 companies from venture portfolios this year. That's up from last year and the year before it, or at least the first half of the year, that is. To put that in context, that means about 1 out of every 4 venture-backed startups that sells globally is selling to a private equity fund or one of their portfolio companies. Another group very active lately in recent years, companies outside of the tech industry, companies in markets like media, retail, healthcare, playing a larger role in delivering liquidity to venture portfolios. In each of the last 2 years, those type of buyers have bought about $9 billion worth of startups. This year, they've spent $21 billion. Of course, a lot of that due to Flipkart, but even setting that aside, we're still looking at non-tech companies delivering about $5 billion worth of liquidity so far this year. And of course, the traditional buyers are continuing to buy and buy at a higher pace. If you go back to 2002 and look at who are the most active venture-backed companies, those are Microsoft, Cisco, Google, Oracle, and IBM. With the exception of IBM, each of those has bought at least 3 venture-backed startups in the first half alone. All of them are at least matching their pace from last year, some even well above it. If you look at Microsoft, for example, has already bought 6 venture-backed companies this year. All of last year, they bought 6. Similar story with Oracle. Bought 3 so far this year, 3 venture-backed startups. Same number they acquired through all of last year. So what's driving these the increased buying? It's all that Brenon spoke of in the broader tech M&A market, the abundant IPO market, the strategic acquirers that are flush with cash and confidence, and it's of course fear. And of those trends, it's the most fun, and it does disproportionately benefit venture-backed companies. So we'd like to dig into that a little bit with this slide. What we've got here is another cut from 451 Research's Voice of the Enterprise. This is our digital pulse survey, same survey that Brenon cited earlier. In this slide, we've asked a different question. We've asked 1,000 IT decision makers to predict how much impact digital technology, changes in technology will have to their company's market over the next 5 years. And as you can see, almost half of them, 46%, a high impact, a high level of disruption over the next 5 years. That's 3 times the number who predict a low impact or no disruption coming. And we can see that play out in the largest deals. I won't spend too much time on those. Brenon already talked about the ongoing sort of M&A battle for Flipkart, for PillPack between Walmart and Amazon, the change of heart that Microsoft has had in open source software, paying up for GitHub. In that deal, you can certainly see a reflection that maybe Windows is not as big a part of Microsoft's future as it was in the past and as Azure is becoming. Or looking at a deal like Roche Group's acquisition of Flatiron Health, pharmaceutical giant paying $1.9 billion for its Flatiron Health, a EHR software provider, with the hopes that with EHR software will come new ways of gathering patient data and potentially disrupting the regulatory approval process and speeding the time to market for cancer drugs. And we've talked a lot about the high end of the market, those large deals that get the most money, get the most attention, but in venture exits, the trend is operating across deals of all sizes. It's not just those largest deals. So far this year, the median size of an exit for a venture-backed company stands at $123 million. How does that compare in past years? If you look at each of the last 4 years, the median size of a sale of a venture-backed company is about 55 million or 60 million. There's not been a lot of variance this year so far. That median deal size has doubled. So it's trending all through the market. And there's reason to think it could continue. We've got a cut of data from our Tech M&A Leaders Survey. It's a twice yearly survey that we do with the law firm Morrison Forrester. Looking at the blue bar, you can see we've asked our panel of corporate executives, of investment bankers, VCs, private equity practitioners, and other M&A professionals to give us their outlook on private company M&A valuations. And in the most recent survey, full 38% of them have told us they expect valuations to increase. It's the first time since April 2015 that a significantly larger proportion have predicted increasing valuations. And historically, that's correlated quite well to the way valuations have trended in the market for VC exits. If you look at the projections from April 2014 and April 2015, the beginning of that market, of those years rather, they predicted an uptick in valuation, and that's the way it played out. Each of those years, we saw median for VC exits above 5 times trailing revenue. This year, we're standing at 6 times trailing revenue, well above the norm we see of typically around 3.5 or 4 times, which is say, of course, that could change. We're only halfway through the year, but things looking like they will continue to be high. So for more on the source of most of the M&A information that we've covered today, I'd like over to Tim Miller for more about 451 Research's M&A knowledge base. Tim?
Great. Thank you, Scott and Brenon. Because of our time delays here with the cutouts, I'm going to mercifully greatly truncate my nakedly commercial pitch here, but boil it down to 2 points. The 2 points I wanted to make are, why are we seeing an increasing number of corp dev clients, particularly, signing up to this tool? First reason is that increasingly the folks on the other side of the table are using our tool. You can see about 80% of active tech bankers right now are using this tool. So it's kind of being on the same playing ground and leveling the playing ground. That's one of the reasons we're seeing that. The next reason has to do with what you're going to see scrolling across your screen right now. A large number of estimated transactions in our database that again date back to our history as a company covering emerging tech companies with great focus on private companies. So you see in many cases for very, very hot segments like machine learning, cloud enabling technology, et cetera, we are providing 2/3 of the comps in many cases in the database, and by comp I mean multiple of trailing revenue, are a result of us having a proprietary estimate of the deal value or the trailing revenue or both. And as you can see for private equity, 70% or more of the comps, both of trailing revenue and multiple of EBITDA, are a result of our estimates. So we believe that's more leverage for corp dev folks. They seem to be agreeing as well. We would like to certainly provide you any ammunition you need to make the case if you're a potential client. And the best way for you to find out about this tool is to actually request to clientservices@451research.com a demo. Just send an email. We'll get back to you and suggest a couple of times, and then we'll schedule a 45-minute call, take you through the M&A database. That's my commercial pitch, and we have a couple minutes left just for Brenon to talk about some of the questions that have come in, and thank you very much for your time.
Yeah, as Tim mentioned, if you're working in Tech M&A, you should absolutely be using our M&A knowledge base, a very powerful M&A tool. A couple of questions. First one actually related to our M&A knowledge base, and that is you seem to be using interchangeably tech and telco. So yes, exactly. When we talk about tech, we talk about tech and telco, so shorthanded to just tech. So it's basically, think TMT without the M is our database. So every time, we were talking, again, to be clear, global basis, all technology and telecom. A question here, a couple comments about the lost audio. Again, we apologize for that. You know how these new systems can sometimes, we just upgraded our unified communications platform, and let's say it's just not quite so unified. So we apologize for that. A couple of you mentioned that the audio did stop. We, again, sincerely apologize for that. We'll get this ironed out. One question did come in around the IPO market. Do you think that the most recent offering, Domo, will hurt the enterprise tech IPO market? I don't think so. I think it was a fairly as you look at the flow of offerings, obviously record number overall, very strong, double digit for the most part valuations. Not the case with Domo. I think in that case, Wall Street sort of saw it for what it was, and I don't mean I don't mean that disparagingly. I just think that it was very clear the company was spending at a level that was not sustainable. And certainly, had built a business that certainly was, they spent money. And I think, they knew, they had sort of 2 quarters of runway left. And I think they came to market, investors recognized that. But I think also you need to step back and imagine that, like, this is a company that even, for all of the, sort of the bearishness on it, I mean, it still created $600 million of market value. Now, you can argue, well, there was $800 million invested in it, so maybe not a great return, but it got public. And it is approaching a level that they can build a sustainable business. So maybe a little bit of resizing, rescaling of their expenditures will kind of get them back into track. But I don't think, to answer the specific question, I don't see that is going to kind of weigh on the tech IPO market. Certainly not anywhere that sort of derails any upcoming offerings. Because again, I think Wall Street kind of sees that for what it is. It's a one-off acquisition or IPO, and I think the final point I'd make is, it is a down round, undeniably, but it's the first one that we've really seen since Cloudera. So, there's been a lot of healthy offerings, both pricing and aftermarket, to sort of keep that IPO market going. Well, we do have a couple of other questions. Unfortunately, we've kind of run out of time. We hit the top of the hour here. I will get back to you on, there's a couple of ones, again, two more that have come in on the IPO market. I'll get back to you offline on those because I'm afraid we're going to have to wrap. So I would just thank you all once again for your time. This is, again, special M&A, special edition here of our M&A webinar. So thank you for attending. I apologize again for the outages, but hopefully you got some stuff out of that, helps make sense of what's happened, and maybe more importantly, what's coming. So thanks again, and all the best for the rest of the year.